The first video introduced the three cycles in a company with the purpose of explaining the main cash sources known as the operating cycle, the investing cycle, and the financing cycle. Today, we focus on the operating cycle, and more specifically on the key concept of operating cycle, the working capital. If you recall the four-stage financial analysis plan as well, we will put the emphasis on the second stage, investment. Considering that from a financial perspective, working capital should be considered as an investment, and we will later on understand why. The operating cycles displays the cash inflows and outflows resulting from operating activities. This depicted the time required for a company's cash to be put into its operations and then returned to the company's cash account. A company's working capital is the balance of the accounts in direct relation to its operating cycle, essentially customer, receivables, accounts payable, and inventories. All of the components of working capital at a given point in time disappear shortly thereafter. Inventories are consumed, suppliers are paid, and receivables are collected. But even if these components are consumed, paid, and collected, they are replaced by others. Working capital is therefore both liquid and permanent. How do you calculate working capital? The balance sheet is required to compute the working capital. The balance sheet lists the assets, liabilities, and equity accounts of the company. Assets are listed from the less liquid to the most liquid. Liabilities are listed from the longest terms of repayment to the shortest. The balance sheet is prepared as on a particular day, and the accounts reflect the balances that existed at the close of business on that day. The balance sheet is prepared on the last day that the income statement covers. So if the income statement is for the period starting the 1st of January and ending the 31st of December, the balance sheet would be at the 31st of December. The net balance of operating uses and sources of funds is called the working capital or net working capital. If uses of funds exceed sources of funds, the balance is positive and working capital need to be financed. This is the most frequent case. If negative, it represents a source of funds generated by the business cycle. It's quite uncommon. It is described as working capital because the figures reflect the cash required to cover financing shortfalls arising from day-to-day operations. Working capital can also be called working capital needs, working capital requirement, or requirements for working capital. So the formula to compute it is current assets minus current liabilities. Current assets covers inventories and trade receivables, and current liabilities covers short-term liabilities, essentially vendors. Working capital plus fixed assets is named capital employed. Financing comes from shareholders' equity and net debts, mainly from banks. It is called capital invested. Working capital turnover ratios measure the average proportion of funds tied up in the operating cycle. 4 ratios are useful to assess how the management performs. Ratio levels may vary from a country to another, from a sector to another, depending on business relations. In the water business, it is not relevant to focus on days inventory outstanding as there is no water inventory. Days sales outstanding and days payables outstanding should not exceed 2 or 3 months, and working capital turnover should be between 2 and 3 months. Days sales outstanding, you divide accounts receivable by sales, including VAT, and you multiply by 365 days. Days payable outstanding, it's accounts payable divided by purchases, including VAT as well. Days inventory outstanding, it's inventory and work in progress divided by sales. And working capital turnover, it's working capital divided by sales. There are 3 existing leverages in the management of working capital. Clients' accounts receivable can be diminished through the improvement of the billing process. Billing, increase in meter reading frequency, or collection process, monthly direct payment, prepayment. Suppliers, an efficient manager does not pay as late as possible but order just in time, as suppliers need regular cash flow in to operate normally. Stocks, by ordering just in time, the financing cost of the stock is paid by suppliers, assuming that logistic and delivery date are under control. So how to manage working capital? Reducing account receivable, delaying payment to suppliers? No, it is not advisable, and cutting inventories. The manager of a water company has to get acquainted with the extent to which the level of activity can impact the working capital. So let's assume that water sales have doubled during the year and that working capital turnover ratios are stable. What are the consequences on the financial structure? So on the left, you have the balance sheet at the beginning of the period. And on the right, you have the balance sheet at the end of the period. So, conclusion, after a year, the company will go bankrupt if shareholders and bankers do not bring new sources of funds. Working analysis should also factor the seasonality of the business. Working capital could be distinctive throughout the rainy season and drought season, a phenomenon directly linked with production and demand levels. You see that in this case, the working capital has doubled because of inventory and because of clients' receivable. What is the relation between EBITDA, cash flow from operations, and working capital? Operating cash flow is derived from the P&L and the balance sheet. The key operational distinction between the EBITDA and cash flow from operation, CFO in short, is the change in net working capital. If you remember our last video on water company margin analysis, we explained how to compute EBITDA margin from the P&L. Change in net working capital is computed from the balance sheet. So EBITDA is equal to operating income plus depreciation plus amortization, which is equal to EBIT plus depreciation plus amortization, which is equal to net income plus income tax expense plus interest expense plus depreciation plus amortization. And cash flow from operation is equal to net income plus depreciation plus amortization minus change in working capital. So what is the relation between cash flows from operation, EBITDA, and working capital? If EBITDA to sales ratio is 10%, working capital to sales ratio is 20%, and if sales increase is 100, What is the impact on cash flow from operation? So the increase of EBITDA is 10. The change in working capital is minus 20. So the cash flow from operation will be minus 10. Cash flow from operations will decline because of sales growth. So managing cash flow in a growing company is challenging. How to compute changes in working capital? Changes in working capital generally explains a lot in a company's cash flow position. So we take inventory plus account receivable minus account payable. For year Y, we have 50 plus 120 minus 80 is equal to 90. 90 in year 1, 120 the year before, so the difference is minus 30. So you can compute change in working capital with two balance sheets. Performing a financial analysis does not always require computing changes in working capital. Information is available in the cash flow statement, which is one of the mandatory statutory financial statements. Bear in mind that an increase of working capital means that there is less cash available in the company. The purpose of the cash flow statement is to provide information about where cash was generated and what cash was spent on. The first part of the cash flow statement states the cash flows from operation. The second part states the cash flow from investing activities. And the third one states the cash flows from financing activity. We will make use of the Water Utilities Corporation from Botswana as case example for this case study. The financial statements of this company are available on its website. All figures are stated in thousands of pulas, the Botswana currency. The computing of working capital ratios involves the statement of financial position, also known as balance sheet. At first, we compute the working capital for 2016 using the working capital formula that you can see on the right top of the screen. The working capital short formula is based on inventories, trade receivable, along with trade payables. In parallel, the working capital long formula also includes all other current receivables and payables. As clearly mentioned on the slide, the current assets and current liabilities can easily be read on the balance sheet. Remember that we do not use cash and borrowing in the working capital formula. So we have inventory plus trade receivable minus trade payables. Following the same method, we can first calculate the working capital for the year 2015 and then focus on the change between 2015 and 2016. The findings are quite surprising since the working capital is negative in 2015 and 2016, which is pretty unusual in the water business. In our example, we can explain this outcome by the fact that trade and other receivables are low compared to trade and other payables. We will investigate this later. Incurably, the fall in working capital level highlights a need for cash on the part of the company. Working capital is negative, trade and other payables are low. 2016 rise in trade and other receivable mostly explain the fall of working capital. Luckily, this similar amount, 52,780, can be directly found in the notes to the financial statement per se. There is no need to compute it. So that's the good news. Now, let's compute the working capital turnover ratios. This calculation requires the amount of net sales appearing on the P&L. Net sales are out of VAT. It is highly recommended to use the VAT included sales in case you know the VAT rate. In this case, we apply a 12% VAT rate. Working capital amounted to 175,688 of PULAs as computed in the previous slide. Since working capital is negative, so is the working capital turnover ratio, which is quite common in the water business. Thereafter, we must focus on the 30 days reduction between 2 years to conclude that the company shows a limited need for additional funding. Ratio number 1 is minus 44 days. Further in our analysis, the understanding of the key factors explaining the working capital trend requires to break down the working capital turnover ratio. For starter, the first ratio to compute is the days sales outstanding, accounts receivable divided by sales, including VAT, multiplied by 365. This calculation calls for the amount of accounts receivable which do not figure clearly on the balance sheet. Moreover, in case we want to perform a more tuned analysis, we can find the accounts receivable in the notes to the financial statement. However, in the event of a quicker analysis, we can make use of trade and other receivable. So we have already computed the net sales including VAT for 2016 and 2015 in the previous slide. So the DSO, ratio number 2 for 2016, is 35 days. The change between 2015 and 2016 is plus 22 days. The ratio is less than 90 days, so it's a good ratio. Another instrumental ratio is the days payable outstanding, DPO. It is accounts payable divided by purchases, including VAT, multiplied by 365. This calculation uses the amount of purchases which do not appear clearly on the P&L. Hence, we need to look for this information in the notes to the financial statement. Or we can use the water treatment, distribution and administration expenses to carry out a quick analysis. Don't forget to adjust the numbers with VAT since the P&L figures are displayed out of tax. Once we have the denominator, we need the numerator, which is comprised of accounts payable. Accounts payable do not appear clearly on the balance sheet. We can find out accounts receivable in the notes to the financial statement, but since we took water expenses as denominator as well as administration expenses, it is consistent to use trade and other payables for a quick analysis. Strictly speaking, if we prefer to focus on the accounts payable, then we should deduct from the water and administration expenses those which are unrelated to accounts payable, including payroll expenses, for example. So DPO, our number 3 ratio, for 2016 is 117 days. It is more than 90 days. So it is not a good ratio. The last major ratio is referred to as the days inventories outstanding, DIO. It is inventories and work in progress divided by sales, excluding VAT, multiplied by 365. This calculation involves the amount of sales displayed on the P&L and the amount of inventories displayed on the balance sheet. The DIO, which is already quite low, has decreased over the last 2 years. According to the notes to the financial statement, inventories are comprised mostly of spares and consumables. The ratio is less than 1 month. So it's a good ratio. So what is the conclusion of our working capital analysis? In closing, we can conclude that analysis with the following statement. DSO and DIO were found out to be quite short, which represented a good performance, while DPO is considered to be too long, but appear to be one of the causes of the working capital turnover ratio short length. Does it mean that the company has difficulties to pay its suppliers on due time? Some in-depth investigation should be carried out to clarify this issue. The performing of a good working capital analysis cannot be achieved without looking at the ratio trends over 2 or preferably 3 years. In order to do so, we can build a table comparing key ratios. This dynamic analysis shows that the working capital structure of the company had the same pattern between 2015 and 2015, only it has worsened over the year. Concurrently, there is a huge fall in the working capital turnover ratio owing to a longer day sales outstanding. Since DPO is computed in days of purchase, the ratio cannot explain the rise in working capital turnover. While computing the DPO based on sale and not purchase, we came to the realization that the DPO has diminished by 12 days. To have a better comprehension of this atypical working capital structure, we need to observe in detail the notes to the financial statement. We find out that trade receivable recorded a large increase, plus 104%, especially when compared to the rise in turnover, which is plus 30%. We notice that the provision on impairment of receivables has a significant impact on this augmentation, since the growth rate of gross trade receivable is only 72%. The rise in trade receivables is the root cause of the working capital deterioration over the year. Trade payables and payroll accruals recorded an increment slower than the sales growth, which impacted negatively on the working capital turnover ratio.